thank you very much. It's a pleasure to be here along with my distinguished panel. And we're going to dig into this question of the continuum of capital. So you've heard quite a lot about it, and I'm sure that you have accumulated a lot of questions about it that you are really eager to direct, not to theoreticians, pundits, analysts, but to actual practitioners who are trying to make this work to drive impact and financial return. So I want to just make some initial remarks here. I think we can all reflect on how simple the world used to be when, if you wanted to make money, you made business investments. If you wanted to drive impact, you gave your money away to social purpose organizations. But of course, the reality is that the world was never quite that simple, that there were always social purpose organizations that had diverse revenue models, and it was never true that for-profit businesses did not also have the potential to create really extraordinary social value. As if we needed a reminder, we certainly got one with the performance around the Millennium Development Goals. All that said, it's clear that the world has become much more complicated as we've seen the emergence of a lot of very discrete alternative ways of approaching social investment that reside between traditional philanthropy and traditional business investment, the so-called continuum of capital, the defining characteristic of which is the desire to achieve some kind of combination of both social return and financial return. That said, this new environment actually poses quite a lot of challenges, and I suspect that many of you are dealing with this firsthand. And if it weren't challenging enough simply to try to determine what your own investment objectives are and to create a portfolio that has some prospect of achieving that, the fact is that at this point in time, this space is also quite confused. There's a lot of clutter out there, whether that's the hype around the ability to have it all and sacrifice nothing, or whether it's the absence of information and data about real experience, or whether it's the punditry, the establishment of people who have all sorts of interesting things to say, very little data to back up what they're saying, but contribute to the creation of expectations and so forth. So I'm pleased to say that in that context, we have assembled a panel whose objective today is to try to cut through the clutter and inform the fundamental question that we are assuming is on your minds, which is, how do I proceed to allocate my capital to best achieve the aspirations that I have for a combination of social impact and some financial return? And to address that question, we've assembled a very distinguished panel that I will now briefly introduce to you, starting to my left. In fact, I'll actually introduce in the order in which the speakers will offer their remarks. So the gentleman from me, to your right, Charly Kleissner, is a distinguished private investor, and he's also co-founder of Toniic, which is an organization whose purpose is actually to support and assist impact investors in achieving their aspirations for impact. Then Charly will be followed by Chen, who is the founder of the RS Group, which is a family fund of funds that is oriented toward achieving a blended social and financial rate of return. Then to your right from me is Manoj Kumar. Manoj is with the Tata Trust and is responsible for an organization called the Social Alpha, which is a very interesting new initiative of the Tata Trust that is intended to support the actual development of social enterprises that have sustainable revenue models. And then to the far right is Abhilash Mudaliar, who is the Director of Research for the Global Impact Investing Network. So we will be talking a lot about portfolios, and I hope you appreciate that we actually have a very interesting and I am sure very productive portfolio of speakers here, because we have Charly, who will begin by primarily addressing the challenge of an individual investor in trying to reach certain goals, blended social impact and return goals. Then Annie will be able to address her challenges in looking at assembling a true integrated portfolio that has a certain targeted type of performance. Manoj will then address the challenge of balancing this blended return in the context of a fund that is actually trying to create success stories among social entrepreneurship organizations. And then finally, Abhilash will be able to provide some broader field perspectives. So, to tell you how this is all going to roll out, we'll start with each of the panelists talking for no more than 7 minutes. So those of you who are like really rabid about this can keep your own score here. But each of the speakers is actually going to address potentially 5 basic topics. So we'll walk through the same type of perspective, which should help each of you then pull out different observations amongst the different panelists. So they'll start by addressing a question of like what it was that actually brought them to the social investment space. So why is this of interest and why is this relevant? Second then, how they define success. So as they embark on the challenge of assembling a portfolio or any discrete investments that yield both social and financial return, how did they define victory for themselves? The third topic then will be sharing some of the challenges they face in actually making investments, in the hard decisions around placing money behind opportunities, discrete opportunities. Then, of course, we'll move to how they assess their success against the objectives that they set out to. And then I've invited each of them to address a bonus question, which is to elaborate a little bit on the subject of exits, which of course is where the rubber really meets the road in any investment endeavor, but it's especially complicated in the context of social investment or impact investing. And so where all of them have some degree of experience with exits, and so we'll invite them to talk about how they think about exits and what has actually driven exit decisions where they've been able to do that. So this will take about a half an hour. Then we will have a moderated discussion amongst the 5 of us, and our commitment to you is that we will reserve at least 15 minutes, and we know we're a little time constrained here, but we'll reserve at least 15 minutes for you to ask questions of our distinguished panelists, because again, the whole purpose of this is not new theory, new hype. The whole purpose of this panel is to share with you real experiences from people who are actively engaged in making these kinds of investments with the hope for intent of informing your own thinking about what you do so that you can achieve your aspirations. So, sound like a plan? Yes, it does. Great. So without further ado, let me turn it over to Charly Kleissner.
Well, thank you so much, Paul. So 7 minutes, we'll see how we do on that one. But I'm happy to be here, very honored to be here, so thank you for attending. Quickly about why we do this impact investing. And when I say we in this context, it's really my wife, Lisa, and I who have embarked on that after a very successful career in Silicon Valley in the 80s and 90s, where I worked with Steve Jobs at Next to create the System 10 operating system of Apple, and then Ariba, which we took public in 1999 very successfully, and that created quite a bit of wealth. And so we had to ask the question about the meaning of wealth to us as individuals, and to us as a couple. And at that point in time, either you break apart or you get together and continue your life with more intensity and impact. And fortunately for me and Lisa, the second thing happened, because we were on the same page on that one, very much agreeing that the only possible answer to the question of meaning of wealth to us is to make a meaningful contribution to the planet and humanity, not and to align wealth with our values. We fundamentally believe that wealth comes with responsibility, and if you decouple that it's toxic. And we have been fortunate to be able to drive that topic not only with us, but with our kids and with the networks that we created. But not only is it, in our opinion, a personal responsibility to align your wealth with the values that you believe in, but it's also clear that we're at the beginning of a major transformation, and I'm grateful for Mr. Ono-san to have keyed up a couple of thoughts that I want to key off of that really spoke to us, Lisa and I, very clearly, namely the limitations of grant-based philanthropy only and the global financial system as it is going to change, in the next few years. To us, it's clear that modern portfolio theory is not the right theory. It assumes that we're all rational investors, and it is okay with externalities like climate change, social injustice, and inequality to accept that. It's not okay for us impact investors. And I think for philanthropists, similarly, it cannot be okay to accept that as the ultimate theory that we let intermediaries guide us through our desire for meaningful impact. So for us, the motivation is both personal and systemic. And so let me go to the second question of how to define success. So, when you do a portfolio approach to impact investing, then you do individual investments. And it's fairly straightforward to define what means success in the context of a single investment, because you have criteria of financial success and impact that you can use to say, well, this is either a success or not a success. In the context of a portfolio, however, if we invest in social entrepreneurs, where sometimes we expect to lose money and sometimes we expect not to have a financial success. And so in that context, we have metrics where over the whole portfolio, if we lose some money and we have impact, that's still considered success. Furthermore, our objective is to change the financial system with 100% impact portfolios. And if we set out 10 years ago to prove that we could build a 100% portfolio with what's referred to as competitive financial returns, market rate returns, which actually don't make sense, and we can talk about that later today. But that's what the existing system demands from us. And as the new system emerges and the old system is dying, we still need to speak the language of the old dying system to make our case. And so we made our case in the context of comparing ourselves to benchmarks that are accepted by the industry. And we proved that we actually have competitive financial returns. Now, had we not proven that, if we had copycats that actually copied our approach and would have been successful, that would still mean success for us. And furthermore, I think that deep impact investors not only align their wealth with the impact that they want to have, but their lives. And so Lisa and I, we measure our success in the context of, do we actually make the high integrity decisions in the points of our lives where we have a choice? And at the end of our lives, if we can say yes, I think then that's success for our lives. So the third question was, do we have a point of view how to construct a portfolio? Boy, do we have a point of view. And so I think the classical way of constructing a portfolio is useful to a certain extent. And we all can start out with the asset classes, if you wish, and then overlay each asset class with impact. That's what we have done. We've looked at our cash and looked at where can we deploy our cash transparently so that we know what it's doing with the impact that we deserve. We've looked at the liquid portions of our portfolio and tried to figure out where we can go deep enough so that it meets a minimum threshold for our impact. And so on and so forth. Since I have only 7 minutes, I cannot go into a lot more, but we can go into a lot more detail. As a matter of fact, we have created organizations like Toniic and the 100% Impact Network, where all of the 100%ers are driven by aligning their portfolios with 100% impact. And we published a report last year that summarizes the experience of 51 of these portfolios, representing almost $2 billion in explaining how they go into different asset classes and overlay that with impact and how they meet their impact goals and their goals for financial returns. And this is just the beginning. We're at the beginning, we're not alone anymore. This is a global movement, and this coming year we'll have 100 plus portfolios, and we'll be able to share the data of impact risk with the research community to figure out the postmodern portfolio theory, where we take our own biases into account. We believe that we take less risk than the establishment, but the establishment doesn't believe us, so let's prove them wrong, right? and figure it out. We believe that impact risk needs to define the appropriate financial return, not the other way around. If you take the venture capital community, they optimize for a single-time financial return with no discernible desire for impact. We are just the opposite. We want to have long-term sustainable impact with the appropriate financial return. So I got to almost number 3, and I'm going to summarize number 4 very quickly in half a minute because I'm starting to get over time, and then look forward to diving in more in other aspects. So the 4th question was, how do you assess your own success? Well, I just told you that we made the financial return, but, and funny enough that everybody always asks us about the financial return first, even so we set out to do impact, right? And so since we proved that, now we have an impact report and we can prove to you, that we are actually indeed making progress in changing the financial system and building a movement together with you. So thank you so much. We might be able to talk about the other 2 questions later.
Thank you, Charlie. Just one quick follow-up question, though. Could you elaborate a little bit more specifically about how you actually think about literally the impact that these investments are intended to create? So you've talked about the broad effect that they would have on the financial system, but when it comes down to looking at a discrete investment, what exactly are you looking for?
I just had the privilege to talk to Suzanne Beagle here in the audience this morning, and she's using Toniic version 2 tool, where we actually, for each impact, enable our members to not only explain or write down the expected financial return, but also the expected impact. And so the way that we do that is that you can go either top down from explaining how you map it to SDGs, Sustainable Development Goals, or you can go in from the bottom up and you say, I map it to IRIS, to specific metrics that are either IRIS defined or not, and then move back up to outcomes and back to your theory of change. So it's not one or the other, and impact investors, impact management is not a science yet, and so I invite particularly philanthropists and impact investors to collaborate a little bit more to put more science behind that.
Great, thank you. Annie?
Hi, thanks. So Charlie is a difficult act to follow because he's such a great presenter, and I have to tell him yet again that he and Lisa were role models for me when I started on my own journey. They're really pioneers in this field, and on the other hand, it's also good to follow Charlie because he said most of everything that I want to say in terms of motivation for going 100% for impact. As Paul said, RS Group is a family office, which means that we actively manage a pool of assets. But in my case, I'm not as smart as Charlie, so I did not make my own wealth. I inherited my wealth. But that brought about another kind of set of questions for myself and for my family in terms of how to relate to the wealth. And having spent more than a decade working with my siblings in our own family office, I can see that when you focus on wealth preservation without a higher purpose, it's easy to just let different opinions kind of come between you. And what I've discovered since embarking on my own journey of investing with an alignment with my own values and building a team that share those same values is that we hardly ever argue because we all have a higher goal, a higher purpose that we're all working towards, and that helps us kind of work very well together as a team. So my own journey to adopting what we call a total portfolio approach really started with what I thought at that time was, just looking at what can I do on the philanthropic side, because not being an investment professional or having much interest in that area, I was really more interested in how to spend down the money that I have. But at one of these conferences, I discovered social entrepreneurship, got very intrigued, and to make a long story short, when I heard at a keynote speaker at one of these events say, all businesses should be social enterprises. Now remember, this was 2008, around the time of the financial crisis. People could see how ignoring externalities, as Charly said, can really run the entire economy aground. And it just made sense, right? All businesses ought to factor a whole lot of other stuff in beyond just looking at financial returns. And with that impetus, I started looking at how to deploy my own resources and build a capital that's sustainable, that has values and impact as an additional lens through which we select our investments. How do we think about success? Well, it kind of depends. At an individual, by the way, I should say that we invest mostly through funds, as Paul said. In a way, we're a fund of funds, I suppose you can think of it that way. So at an individual investment level, obviously, for depending on where that investment sits, and what asset class it is, we would be looking for a different combination of financial return and level of impact. I wouldn't equate, investing in global equities with investing in private equities with a purpose mission embedded in there, right? But we also look at performance at a portfolio level. At the end of the day, we're managing this whole pool of assets. And there, I think we're looking for a specific financial target, which is a reasonable return or enough return for us to cover our own expenses. We have to run a team. We have a certain grant budget for every year, so we need to be making enough to help us run sustainably. And that, of course, we also care about the impact that we have. Now, I have to say that as we were developing this portfolio, I hadn't developed, kind of my own theory of change, if you will, in terms of what thematics I want to focus on. So it's a bit broad. We did put out an impact report last year, and if you're interested, you're very welcome to come to our website and take a look, where we discuss both our financial performance and also our social and environmental impact performance. And at a sector level, we are also feeling that we have a particular responsibility as early practitioners of this approach to build the field. And the report was one such attempt to share our own journey, to show others how it's done in one particular case. It's not to say that that's the only way to do it, but we're just putting out this example, hopefully to inspire others to realize that it is possible to do it if you put your minds to it. Challenges that we met along the way, I would say at the beginning, would be simply a lack of knowledge and experience, particularly out in Asia. Like a lot of Asian family offices, our first stop was the private bank. But the level of awareness, not only of impact investing, I suppose the term wasn't as popular then, but even of sustainable investing or SRI investing was close to zero. So much so that I had to reach outside of Hong Kong to bring in an external financial advisor to help the process of building out this portfolio. The other challenge is that for us, we haven't been able to do as many direct investment or how people normally kind of think of impact investments as being. We haven't been able to do as many of those as we would like because of capacity reasons, because these are, they require a lot of resource, they require a lot of time and effort, and we haven't been able to overcome that because there's also a lack of kind of supporting platforms in Hong Kong. I suppose, finally I would just simply say that we also face some skepticism. We have an independent trustee board that we have to answer to when we decided to embark on this approach. And as you can imagine, we got a lot of feedback saying, well, you're screening out a lot of, investments, so that's going to narrow your investable universe, and that's going to impact your return. But we hope that, over this period of time, we've been able to demonstrate that we're not screening out. We're screening in good investments by using this approach. So I'm going to stop there and kind of allow more time for us to have a discussion later on.
Great. Thank you, Annie. Quick question for you, too, on thinking about the funds. So for the most part, are the funds that you engage funds that have actually positioned themselves as impact investing funds and therefore are already presenting some sort of story around the social impact they create, or not, in which case you would then have an extra burden of ascertaining whether or not they are, acceptable?
Okay, so let me start with, I think it depends on the asset class. For global equities, they don't always label themselves as such. But, having a label is a good place to start because, as we're trying to identify, possible candidates from a large universe, that helps us kind of draw some of the possible fund products out. But we also rely on our external advisor who has a database of these funds for us to look at, to do due diligence on. For impact funds, though, that's a little different because when we first started, there aren't that many impact funds to start with, right? The known ones are like Acumen, Responsibility, Oasis. So we went into all of those. But over time, as we developed maybe particular interests in renewable energy, we would start looking for specific products that fit our needs.
Thank you. Manoj?
Thank you, Paul. So I'm part of Tata Trust. Tata Trusts are India's oldest philanthropic organizations, have been working on forefronts of philanthropy right from institution building, have built India's premier science and technology institutions and grant making in philanthropy, working with about 400 plus NGO partners across the country, working in areas like livelihoods, agriculture, education, healthcare, etc. One of the large challenges that we have faced in past few years that our investment in innovation, right? Having built labs and research centers around the world in universities like MIT in US and IIT in India, what we have seen that while we have at least 100 research projects at any point of time trying to solve developing world problems, we have little traction in lab to market. So how do you take innovations which have been done to solve developing world problems from labs, from research papers, from conferences to create actual impact on the ground and help people for whom they were originally intended to be? So we realized that if we need to build an ecosystem right from lab to market where we can incubate and accelerate startups, we have to go through entrepreneurial route. And there is a limit to philanthropic grant making that we can do. Another big learning for us was when we analyzed the portfolio of top 10 impact investors in India, we looked at their portfolios and realized that 70 to 80% was microfinance, remaining 20 to 30% was services, rural supply chains, distribution networks, arbitrage, disintermediation play. So if there is an innovator who has developed a new protocol for supplying clean, safe drinking water to rural communities, who would invest in that company? Who would invest in new antibiotic? Who would invest in new vaccine? Who would invest in new technologies for providing access to affordable education or healthcare? And this was a big question that we realized that between the lab and impact, there is a huge value of that. And unlike one, there are multiple values of that because the grant funding, some people may keep getting new grant funding, but at some point of time, grant funding stops, whether you have explored all philanthropies and all government, and then you need early stage capital, and that early stage capital is not available. So we built a new foundation called Foundation for Innovation and Social Entrepreneurship with a clear charter that we would search for innovators and entrepreneurs, provide them an infrastructure they need in order to take their products to market, focus on science and technology based products which have non-linear disruptive impact so that we can improve the time to market as well as the impact, and also provide them early stage seed capital, de-risking their business models and helping them reach market quickly, and also de-risk them so that they become attractive for impact investors or commercial mainstream capital so that they can then take the risk. So there is a huge deficit in the risk reward spectrum, right? So the conventional investment paradigm is high risk, high return, and low risk, low return. But there is a quadrant called high risk, potentially low or unknown return, which could actually be very large, but no one knows because no one invests in that space. So how do we create that high risk, potentially unknown return and take that early risk that we being philanthropic capital provider can take and then bring in a large number of VCs or impact investors on board and hand over these nice assets to them. So that's why we moved from philanthropy. So it's not that we have stopped philanthropy. So our philanthropic allocation continues. We continue to build new institutions and do what we have been doing. So we started last year with this new foundation that would promote innovation and entrepreneurship. The risk and the learning was that this foundation is not enough because even if we provide seed capital, there is no source of capital waiting for these companies to go and raise next round. So there's a huge gap in Series A, pre-Series A level as well because the risk appetite of impact investors and commercial VCs, actually I see a convergence between the two because they have similar kind of assets nowadays, but their risk appetite is too low. So we decided that not only we will focus on building the infrastructure and this three-tier architecture right from innovation to incubation to acceleration to venture growth, we would also create this new category of capital in between traditional investment and philanthropy that would take early stage risk. So it would have three characteristics. One, it would be extremely aggressive on risk underwriting, will focus on science and technology based products. Number two, it would be extremely patient. I can't dictate exit terms in a company where I don't even know whether this company would be in market in 5 years or 10 years. And three, it would compromise or it would be willing to compromise on the risk return suboptimality, right? So I can't go and raise money from LPs by showing them 30 to 40% IRR cases because I know that in some cases it's just 2 or 3% IRR or may not be positive return, right? And if it was so attractive, then the mainstream business would be doing this. The fact that no one invests in tuberculosis drug while mainstream business is developing Viagra and Botox is clearly an indicative that while most people in India die of tuberculosis, that space is vacant. So who would invest in tuberculosis new antibiotic when the bacteria is drug resistant and everybody knows it? It's public knowledge. Everyone knows that the bacteria is. So we are trying to look at those spaces in science and technology where we can de-risk business models and make these companies investment ready. Right? Making them investment ready is something I would say that forces us to get into this space. I think I've taken too much time just explaining why we are doing it. So the challenge is to find the entrepreneurs and innovators, right? We find innovators who may not be entrepreneurs. We find entrepreneurs who are willing to roll up the sleeves and do the basic operating stuff, but they don't have access to technology. So we try to bring them together, and that's a challenge that we are trying to solve. And also trying to find the right LPs. So I'm raising our first maiden fund at the moment. It's a $30 million fund, and I'm extremely reluctant to take money from everybody and anybody because people are thinking about us the way they think about a 30% IRR promising PowerPoint presentation they have seen in impact investment world. So it's extremely important for us to say no and take money from the right sources. Yeah. So I can talk about it maybe at a break or something, but time is up, so I must stop.
So thank you, Manoj. It sounds like in your instance, you have a somewhat more challenging, I mean, everyone has a challenge in getting their arms around impact. It sounds like your model suggests a greater challenge relative to Annie and Charly in terms of getting your arms around potential economics. And I think we can all appreciate why the high risk, low return segment represents a gap. So can you just talk a little bit more about how you approach the determination of whether an entity actually has sufficiently attractive potential financial return to be interesting to you?
So for us, financial return is financial sustainability. So when we look at startups, we look at their business plans. First, we look at what problem they are trying to solve, and is it a problem that aligns with our problem statements. The second thing, we look at their business plan, founders' background and business plan, and their ability to create a business model that over a period of time can become financially sustainable. But we refrain from creating a target IRR at exit because we think that so we are very hands-on, right? So we operationally get involved with our portfolio and we figure it out as we incubate and accelerate the startups. So we don't start with a target exit return proposition. We don't do that. I don't know whether we'll continue to do that because it's quite new, but as of now we have decided that that may refrain us from actually finding the right company. So if somebody is working in assistive technology and prosthetics, right, creating a very successful business model can take several years to fix that. Same with the vaccination. Same with nutrition. So we are one of our portfolio companies is actually developing a new RUTF that will solve the malnutrition issue in some of the developing countries and also in disaster situations. Now, how do you create a profitable business model around RUTF? And I think we have a profitable business model, but I can't predict what it would be. Yeah, so we will continue with that asymmetry.
Thank you. Abhilash?
Thanks, Paul. So I think I've been fortunate that I've been in this sector since almost the beginning of my career. When I came out of college, I began just in a fairly standard strategy consulting firm. And I did that because I think at that age I wasn't too sure what I wanted to do with my life, and consulting is usually a very easy place to start while you figure things out. But I realized pretty quickly that this wasn't particularly fulfilling or meaningful. I was spending till about 10 p.m., 11 p.m., midnight in the office every day, trying to figure out ways to increase the margin of my clients, increase their profit margins by 1 basis point or a fraction of a basis point, and wasn't particularly fulfilled by that. And so I started doing some Googling, wanting to do something with more of a social development type objective. When I came across this term called microfinance, and this was in 2005. This is before microfinance became sexy. This is before Professor Muhammad Yunus won the Nobel Peace Prize for microfinance. And so I'd never heard of it, but the tagline said, using market forces to address poverty. And I thought, oh, that's interesting. I've never really thought about using market forces to address social challenges. And so I started researching this a little bit more, and within a few months, I moved to India to work in the burgeoning microfinance industry in that market. And over time, that took me into one of India's first impact investing funds, and pretty much have been in the sector ever since. Joined the GIIN 4.5 years ago, specifically motivated by research, which is where I work right now. And largely because I think this industry is so young and nascent, but at the same time fast growing, that there's a strong need for research and data and evidence on what's actually going on. What are the opportunities? what are the challenges, what are the actual performance of impact investments, what's the potential, what are realistic expectations. And we think only with good quality data and evidence and research will impact investors significantly increase their allocations and also do so in a much more efficient and effective way. And so I think it's a really exciting time to be a researcher in the impact investing space, and that's where focused my energies over the last several years. So what is success? So I obviously am not an investor myself. The GIIN is an organization that's similar to the AVPN in that we work at the ecosystem level, and we're trying to build the field of impact investing. And so success for us, ultimately is really about a change in mindsets and to change investors' perceptions about the role of capital and the role of business in society, and which is what Annie alluded to as well. It's not just about making profits, it's about making a positive contribution to planet and to people's lives. More practically, I think what that means is, we want to encourage investors across the risk-return spectrum to begin allocating capital and allocate significant capital towards impact investments. Ultimately, and we want to go where Charly has already gone, which is towards 100% impact. Ultimately, we want to get to a stage where impact investing just becomes the new normal, and it's not so much niche, but every impact investment is made through an intentional lens that's focused on the impacts on the planet and on society. So I think that would be probably a stretch goal in terms of success for the GIIN, and that's where hopefully the industry is headed and moving in that direction. Challenges, again, I think as an industry body, we're focused on the types of needs or constraints, if you will, that prevent investors from deploying capital at scale and doing so more efficiently. And I won't go into a lot of these in detail, but for instance, if I'm interested in impact investments, how do I start? How do I find impact investing opportunities? And again, Annie touched on how when they began their journey, there were 2 or 3 funds that they could identify. And so we've worked on developing a database of 420 plus funds now all across the world, which people can access for free on the GIIN's website to begin identifying impact investment opportunities that match their geographic focus, their impact theses, sector needs, financial return expectations and targets, etc. Similarly, another challenge investors face is, how do I measure my impact? And so we're working to develop IRIS as a standardized taxonomy of impact measurement metrics, and it's received wide adoption across the impact investing community. The majority of impact investors now use IRIS metrics in one form or another to measure and manage their impact performance, and so on and so forth. And so, those are the types of collective challenges that we're trying to address. And finally, results and success. So, one of the things that we do is we conduct an annual survey of impact investors worldwide. We've been doing this for 7 years, and the most recent edition came out last month, and 209 impact investors responded to this survey. One question that we ask them every year is, how have you performed against your expectations, both on the financial side and on the impact side? So this can give you a sense for success and satisfaction with performance. What we found in the most recent edition of the survey is, on the impact side, 2% of respondents said that they've underperformed, 20% said that they've outperformed, and the majority, 79%, have said that they've performed in line with expectation. On the financial side, 9% reported underperforming, 15% reported outperforming, and again, the majority in this case, 76%, have reported performance in line with expectations. And again, I think that corroborates some of what Charly and Annie were describing about the performance of their own investments and their own portfolio over time and the satisfaction with that. Lastly, I'll just touch on what does success look like at the industry level. And the year 2017 is actually the 10-year anniversary, as many of you would know, of the coining of the term impact investing. Many people had been making impact investments for obviously long before 2007, but I think the coining of the term in the year 2007 signaled something very symbolic, and that is disparate actors coming together to try and build a coherent industry. And now that it's been 10 years since the term impact investing was coined, one of the major projects that we're undertaking right now at the GIIN is actually taking stock of how have we evolved as an industry. What have been our successes over the last 10 years? Where have we fallen short? What have we done very well? And then where do we want to be in the year 2030 when the Sustainable Development Goals actually mature? What does a future vision look like, and what does success look like for impact investing in the year 2030? We're actually consulting with hundreds of stakeholders all around the world currently and over the next several months to figure out the answers to these questions. And so if you're interested, I encourage you to come and reach out to me at some point later today, and happy to talk about that and to gather your perspectives.
Thanks, Abhilash. I've got to tell you, I feel honored to actually have the opportunity to ask Abhilash a question about this survey, because as long as I've seen the survey, which is routinely it's the single best source we have of getting a sense about what the impact investment market is, I've always wanted to ask this question. And that has to do with the N on your survey. So you mentioned there were, 209 respondents. So how does GIIN go about determining who is an impact investor and therefore qualified to receive this survey in the first place?
So we obviously go through, there's a couple of things I'll mention. First, we identify potential respondents through a range of credible networks around the world that have already, I guess, vetted their members and their stakeholders for impact intentionality. So through the GIIN membership, through Impact Base, through Impact Assets 50, through networks such as AVPN and EVPA, etc. Through that, we generate a long list. Additionally, we provide, I think one of the most important things we do is right up front in the survey, we, in bold and caps and underline and all sorts of emphasis, we make clear that this is for impact investors. We define what impact investing is, and that responses only apply to the respondents' impact investing portfolios as they define it through their intentionality lens. And so that often leads to some respondents who don't actually meet the criteria, and they drop out of the survey very early on.
Great, thank you. So we now we'll have something of a dialogue amongst the panelists, and then again, we want to reserve some time for all of you to ask questions. Given the overall time shortage, this will be a little compressed, but we want to make sure we get time for you. The first question that I'd like to pose to the panel has to do with the trade-off between social return and financial return. And this is one of the great questions that surrounds impact investing. Some people suggest that there is no trade-off. Other people suggest that there's an inherent trade-off. So each of you has described kind of how you approach it for yourselves. So I'd like to hear you share your own thoughts on that trade-off. And how real is a sense of a trade-off between social impact and financial return in the approaches that you take and the decisions that you make? Any of you?
I can quickly start with sort of a broader industry perspective. I think firstly, a blanket statement at either extreme, I think, is probably wrong. And that is a blanket statement that there is never a trade-off or that there is always a trade-off are probably both wrong. And the correct answer is it depends. And we've done some research. We've surveyed investors around the world, and I think there's an overwhelming majority that agree that there are certainly some impact investments and some opportunities, just given the nature of the product or the customer or the distribution model, that will never lend itself to risk-adjusted market rates of return or competitive returns, and that there is a trade-off in some cases. But also, I think in a lot of cases, investors emphasize that impact intentionality and impact measurement and management actually reinforces good business practice, and that the two have a strong positive correlation. That if you're impact intentional, you actually understand your customers better, you understand their needs and wants better, you also manage your risks better, and you, in the process, enhance your impact and you enhance the business performance or the financial performance of your investees and your investments. I'm happy to share actual examples of that we've seen in practice, but I'll let some others weigh in.
I've always been a little puzzled by that question because the way I think about it, okay, I also have to say I have as our strategic advisor, Jed Emerson, who developed this concept of blended value, right? So the concept is that for every investment or every activity, it generates actually a whole host of performance, financial and non-financial, right? So it always comes as a package. So that's why I always get a little mystified when people talk about trade-offs. I think it's really up to the investor to decide, well, okay, here's this opportunity. What do I want to get out of this opportunity that makes me happy or that meets my needs or wants, right? And if in the ideal case, everything plays out according to plan, whether it's, less financial return, more impact, or more financial return or less impact, as long as it plays out and meets the investor's expectations, then it's a good investment. There's no trade-off. And then the other thing I want to say is this is kind of the beauty of thinking about investing for impact at a portfolio level, which is that, you put different pieces together so that at the end of the day, when you aggregate everything, you set a target, do I meet my financial requirements? And am I happy with the impact that's generated? Rather than simply saying, well, I'm making this investment into an impact investment. Do I want impact more or do I want financial return more? See what I'm saying? So,
Yeah, I couldn't agree more with Annie and what was keyed up before. As a matter of fact, the majority of the 100%ers don't consider this a very meaningful question because they don't think that way anymore, right? And so it's a question that's being asked by the old system, of course, in their language, because that's what institutional capital, talks about. Is that exact formulation? Us impact investors have a different question. What is the appropriate financial return for the impact risk that we take? So that's a very different question, right? The mainstream is not prepared to answer that yet. And yet I think we need to push that envelope together between philanthropists and impact investors forward, especially in order to figure out what the appropriate financial return is. So our foundation, KL Felicitas Foundation, now that we have shown, if you want to have what industry considers competitive financial returns, you can do that with impact, with certain trade-offs. So, but that's to us a fairly boring question. The more interesting question is, if you build a 100% thematic portfolio, maybe top down according to 1 or 2 SDGs, and you put in a floor of financial return that you want to manage towards, given the impact risk, what's the expected financial return? And we have embarked on a journey with others to show that for a couple of SDGs. So that will hopefully turn the financial industry around, like I said before, from talking about meaningless risk return, which will be meaningless in the next downturn, to actually what is the appropriate financial return long term, given the impact that you want to have.
Just a quick follow-up on that, though, Charlie. So can you elaborate a little bit on how you think of so-called impact risk? Is that probabilities? Is there a magnitude aspect to that?
Yeah. So that is the heavy lift that we need to figure out in the next few years. So we don't have the concrete answer to that because 95% of the researchers are continuing to fiddle around with a meaningless analysis of ESG up and down as opposed to going deeper into impact. And so, but the good news is we have a handful of researchers that we collaborate with that will then inspire the new breed of researchers that want to have a meaningful research that actually makes something, not just write a paper that nobody reads, but actually, writes a paper that has an impact.
So I totally agree with what Charlie said, and just to build on the top of it. So if you look at any business, right, any business is creating impact. People generate jobs and create see, business by definition is impactful, right? Economic activity creates social impact. So when we look at return, we use the risk adjusted return on capital, right? Here you are adjusting the risk, and very few people want to take impact risk, and therefore the capital needs to evaluate what risk you are taking and why others are not taking that risk, right? So there is a priority issue, right? And as long as I'm getting a positive financial return post adjustment for the risk, I think we are creating value, right? In the business, you call it economic value creation, right? As long as you have a positive EVA, here you could have a positive SVA where your value creation is adjusted for the impact. So looking purely from a traditional financial risk management point of view, we may miss the reason for our existence.
Thank you. The next thing I'd like to explore with you is the role of grants. Okay, so the continuum of capital obviously goes all the way from traditional philanthropy and what we always thought of as venture philanthropy, very disciplined, hard-nosed decision-making, but still based around grants. And most of this energy now around impact investing and so forth has had to do with financial return of some degree. And it seems like there's some potential in an environment like that for there to develop a mentality that's like grants are for losers kind of thing. Now, maybe I'm being overly sensitive about this, but the continuum of capital absolutely still requires appreciation for the fact that some people are ready to deploy resources without an expectation return. So can some of you just address how you think in this ideal framework that you each are confronting, how you think about grant money?
So I'll key off of what Manoj said about how to make these enterprises investment ready. There's no business model actually that I'm aware of that can do that profitably. And so that needs to be subsidized. That needs to be grant supported. As a matter of fact, I have one of my superstars of an accelerator here in the audience, Neelam. And so Lisa and I have been building these accelerators in India and in Vienna, Austria, and now in Honolulu, Hawaii, to help educate these entrepreneurs. And you cannot really take an equity stake in that because most of them don't lend themselves to an equity term sheet anyway, right? And so in that sense, but then how beautiful it is then to invest in some of the graduates of the accelerators in blended capital structures, to your point, where grants alone would not be as impactful as grants together with subsidized capital, maybe a loan guarantee or a first tranche loss to then over time attract more commercial capital to scale it up and make it commercially successful.
Do you want me to answer because I see that we have 10 minutes left? Yeah? Or do you want to leave time for a question?
I do want to get to the
Okay,
audience.
all right.
If you have something in particular,
All right,
Annie, by
I'll
all
try to make it
means,
short.
share
So
it.
Charly was talking about the layering of capital, right, and where grant fits in the development of a particular business. I want to talk a little bit about kind of how grants fit into a portfolio, right? Despite the fact that we are not a thematic investor, portfolio, right? Meaning that we only focus on certain themes to invest in. We have found instances where our grant making knowledge that we gained through engaging our partners and understanding the issues that they're trying to solve has informed how we look at investing. And vice versa. So one example is we support an organization that works on land rights, and that made us think, how do you think about land rights and companies that you invest in for whom land rights or land is a very important component? How do they manage that so that they're not damaging communities or adequately compensating communities? So we learn a lot actually from not putting a wall between our grant making and our investments.
Great, thank you. So we now want to open it up for the audience. Yeah, please. I don't know, do we have a mic? We certainly have plenty here that we're happy to share.
My name is Rajan Makhijani. I'm the country director for the Tata Center for Development, very generally supported by Manoj and team at Tata Trust. And my question is to you, Manoj. They say men are from Mars and women are from Venus. And you spoke about innovators and entrepreneurs coming together. And the analogy may not be very far off. How do you get them to talk to each other? How do you evaluate whether this species of innovators, especially science and technology-based innovators whose interests, passion, and drive is quite different from those that have the entrepreneurial bent of mind, how do you work out the chemistry between the two? Do you look for both of them to be present in the same person or in the team? And how do you look for the chemistry, whether it works?
You're touching my sensitive point. He knows me, yeah, very well. So the ideal scenario is where innovators are entrepreneurs, right? And that's everybody's dream. But 1 out of maybe 100, you get it. So what we do, we run an entrepreneur in residence program for people who want to be entrepreneurs in science and technology space, and try to create co-founding teams of innovators and entrepreneurs, because the next best thing is to create those co-founding teams where, say, CTO is the innovator and CEO is the entrepreneur. But ideal scenario would be, the one person that runs the organization. It's not easy, yeah. So I can talk about it in more detail when we meet. But we tried with 2 experiments last year, and both have been successful. So we are actually getting 6 entrepreneurs in residence on board this year, and map them to our research centers in MIT, Cornell, UCSD, U Chicago, IIT Bombay, and some other places, and then see. But we meet and we come across a large number of people who actually work on the intersection of innovation, entrepreneurship, and enterprise. One example, my friend Mohan, here, if you get time, talk to him. He runs RT Lab in India, where they work on assistive technologies and prosthetics, which is deep science, deep entrepreneurship, and great innovation. Yeah.
Any others? Yes. Hi, my name is Daniel Su. I'm from Village Capital. My question, actually for the whole group, is around, we talked about impact at the investment level, and you talked about it at the portfolio level. I wonder if there's like a meta level, and is there impact in bringing the mainstream into this conversation? And I mean, for context, we always say small is beautiful, and I think a lot from philanthropy we believe that. But I mean, Abhilash, you probably have the numbers. We are a very, very small, tiny basis point maybe of total capital flows, and as you talk mainstreaming. Is there impact, in fact, in just showing the mainstream that, hey, there's some good deals here, and bringing in some of that capital to, like as Manoj mentions, any capital that's helping a company create jobs and local economic development, there's impact right there. How do you think of that? Because sometimes when you talk about trade-offs, even though we don't believe that, we don't think that way, the reality is the mainstream at this time still thinks that way. Do we alienate them, or how do you balance that? That's my question. Thank you.
Well, I thought a lot about, what it means to change the financial system, and about 95% of the capital is controlled by institutional capital, and the capital that we represent is actually only 5%, which is about 5 trillion, and the 100%ers comprise about 5 billion of that, which is 0.1%. So I thought, intellectually, what does it mean to flip the system, right? And intellectually, you have to admit that it will not be possible before the next crash, because no matter if you grow 70, 80% year over year, you're not going to be in time to do it. So that's why I'm hopeful that the next 2008, 2009 would accelerate the transformation of the methodologies that we actually invent right now. And if the crash is not too hard, then we can we can rise faster like we did, our portfolio did in 2008 and 2009, right? So at the same time, we shouldn't wait. And because we can not only actively prepare, but I expect the institutional capital to be able to deploy right now hundreds of millions of dollars to low billions. We know how to do that, right, with some impact. And so there is a movement, you know, the one pension fund in Australia has made the 100% commitment. In Netherlands, they're moving quite rapidly. In the US, you know, the lawyers are blocking behind the wrong interpretation of fiduciary responsibility a little bit what's going on. And the current administration is probably not going to help that in the immediate future. But you know, it's progress linearly until, until we, you know, so there's many different angles to that, not just one answer.
We certainly want, I think as I alluded to earlier, certainly want obviously to democratize impact investing, make it more accessible to all different types of investors. The GIIN has an institutional investor initiative to try and get more institutional capital into the space. At the same time, I think one has to make sure that the on-ramp for institutional investors exists. Do we have the right products that enable them to enter this industry in a way that makes sense for them given their risk-return constraints or whatever fiduciary constraints they face? At the same time, we also want to make sure that we're not just bringing in a flood of names or a flood of capital without there being a sincere and rigorous commitment to impact integrity. I think the worst thing that can happen for this sector is there's widespread impact washing, and because it's sexy to call yourself an impact investor, everyone's saying it, even if that impact integrity is not there. So those are two things to balance. And I think the last thing I'll just say on that point, there's the pull factor that you've described, but there's also the push factor. And I think with increasing changes in social norms and wealth transfers to millennials and women, there's a lot of research that shows that there's already strong client demand to align economic decisions, investment decisions with one's values. And that's also pushing managers of pension funds, managers of insurance assets to look more closely at values-aligned investing.
I think we have time for just one more. So
I'll pass. My question has just been answered. Thank you.
The others, yeah, back in the back there.
Hi, my name is Nat Pinoy. I'm from the Ministry of Finance, Thailand. One of the questions that we have been grappling with is that how or what should be the role of the government to actually promote this sort of social investment. Because we know that what you do is helping us solving the problems in our countries or in the developing countries. What should be the role of the government? Should we encourage more investment by issuing more laws, or should we get out of the way? What would be your view on the role of government? Thank you.
Sorry, okay. In the context of Hong Kong, I think the first thing that they can do is to invest their kind of the equivalent of sovereign wealth fund with a sustainability lens and an impact lens, and show it by example.
In a country like India, government is the biggest impact investor. We have huge budgetary allocation to something called public sector. And a few units in public sector actually were created and existed because private capital was not willing to take that risk. So today, private capital is available in certain sectors, but 20 years or 30 years back, it was not. So government did that. So government just needs to recognize that there are people with private capital who are trying to do what in many countries government do. So I see private and philanthropic investment capital in impact world as a parallel to what government has been doing in public sector.
Yeah, I would just add to that one thing that has been learned, especially like through the G8 process in the last couple of years, which organized the G8 countries with national advisory boards to look at impact investment. That was all focused on each country identifying things that the governments were actually doing that could either incentivize or in some instance disincentivize. So it was either creating incentives or eliminating existing disincentives. And Charly actually mentioned one in particular which has to do with regulations around fiduciary responsibility and and that sort of thing. And I would suggest that that's another thing that should be on the agenda of every country, to just ensure that the ecosystem, the regulatory ecosystem, is as productive as possible. Well, thank you all. You've been an excellent audience. Please join me in expressing appreciation of the panel.